Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar.com. In this week's podcast, Mark Miller encourages people to explore their options before filing for Social Security. Christine Benz explores strategies to upgrade your portfolio during a recession. We share 2 stocks our analysts have their eyes on, and our analysts comment on Amazon's big presence in the market. So let's get started. Here's Christine Benz of Morningstar Inc. interviewing retirement expert Mark Miller.
Hi, I'm Christine Benz for Morningstar. Thanks to the economic effects of the pandemic, many older adults may be pondering retirement earlier than they expected. Joining me to discuss Social Security filing during this period is Mark Miller. He's a Morningstar contributor and he's also an author. Mark, thank you so much for being here.
Thanks for inviting me, Christine.
So, Mark, let's talk about what we should expect to see in terms of Social Security filing during this period. I guess it's probably too early to say if we're seeing more people filing for Social Security, but what is maybe the last financial crisis from 2007 through 2009 kind of suggest we should expect to see during this period?
Yeah, you're right. It is too early to really know in any kind of hard data sense. But if you go back and look at that last recession of 2008 through 2010, there was an increase in the number of people who filed early for Social Security. And then after the recession, the claiming trends shifted pretty markedly in the other direction. The share of people who were claiming at the earliest possible age, 62, dropped pretty dramatically from 53% in 2009 to 35% in 2018. Right now, of course, there's just a huge amount of uncertainty about the economy, but it does seem likely to me that many people are going to wind up retiring sooner than they might have expected, either because of the very serious decline in the economy and the job market. And for some people, it's going to be related to the health risks of the pandemic.
Right. So for some people, there may be no other option but to delay to take Social Security as soon as they're able. But let's talk about the benefits of delayed filing if you possibly can.
Right. So you can file as early as 62, but every 12 months that you delay, you get an increase in your annual or in your benefits for every 12-month period that you wait. It'd be below full retirement age, which is 66. The increase is generally about 6% per every 12 months. And then it's 8% for the delayed credits that accrue after your full retirement age up to 70. And at 70, the delayed credit stops, so there's no reason to wait further at that point. But the very substantial increases in the annual amounts that are paid out. And it's worth mentioning that, these are adjusted for inflation. So, it's a really valuable increase in your benefit.
So that helps explain why people like you suggest that if people possibly can, they should delay. But let's talk about people who are looking at their portfolios today. Maybe they saw them drop significantly, although things have recovered quite a bit. Or maybe they just were feeling like, this is a limited pool of resources to begin with. Tapping Social Security might seem safer. How do you address that issue of Social Security filing versus portfolio withdrawals?
Right. And, it's never been the case that folks like me have said everybody should always wait. It's always been a very much of a personal matter, and there can be reasons, even pre-pandemic, why it can make perfectly good sense to go ahead and file. But, the pandemic adds some new dimensions to this. And some of the experts I've been interviewing for various stories who, were like me in the camp that it often makes sense to delay are saying that, there may be other ways to think about this now that, for most Americans have rather modest amounts of saving and, may just want to hang on to what they have from a liquidity standpoint at this point. So taking Social Security early rather than starting to live on your savings, assuming you're not working, may be the way to go for some people just due to the incredibly uncertain environment. There may be situations where, for example, you have a legacy concern, or you may want to hang on to savings to help out adult children who may be struggling with their own careers. So Lastly, there's the issue of the uncertainty about the market. All the usual formulas of amounts you can draw down from savings to live on inflation. Those get to be a little scary if you're withdrawing into a down market and a declining market, so there could be reasons why you'd want to go ahead and get Social Security because it provides that kind of stabilization.
Back to the idea of portfolio withdrawals, let's talk about taxes briefly, because arguably if people find themselves in sort of an income pinch, maybe they've had job loss or in whatever type of income loss, let's talk about how that relates to portfolio withdrawals and might actually embellish the case for portfolio withdrawals versus Social Security filing.
Sure. So for people who might be thinking in terms of delaying past full retirement age and intending to live on portfolio drawdowns in the early years of retirement, there can be a substantial tax benefit to this, especially with the current rates under the Tax Cuts and Jobs Act of 2017, which reduced the rates fairly substantially in some of the brackets. So the point here being that you'd be drawing those monies down from tax deferred accounts, 401k or IRA typically, at a time when you're in a lower bracket. And so it becomes cheaper, if you will, from a tax perspective to make those drawdowns. A lot of the tax experts I speak to about this say, it could be reasonable to think about doing these drawdowns to the point where you fill up a bracket. So it can be a sweet spot in terms of a time to get money out of a tax deferred account, I think is the argument.
Okay. So let's talk about someone who does go ahead and file for Social Security maybe earlier than they had wanted to because they have had job loss during this period, but then they find a job later on. Can you discuss the tax implications for people in that situation or how it affects your eventual benefits?
Well, the interesting thing here in some recent reporting that I frankly was a little surprised by, and I think a lot of people are surprised by this, is that it is possible to file for Social Security and then suspend your benefit later and start accruing delayed credits again. The reason this can be confusing is that there was this whole brouhaha a few years ago about the elimination of the so-called file and suspend feature of Social Security. And that was eliminated. But this is something different that let's say you were out of work at age 62, decided you needed Social Security, you take it. But let's say you get a job again at age 64 or 65. If you wait till your full retirement age, you could suspend your benefit again and start accruing delayed credits again. And those calculations start from the already reduced benefit amount, but nonetheless, you would have the ability to, make up some lost ground, if you will. And so, it is a bit of a do-over opportunity that's out there for people who might need the money now, but let's say they do manage to get reemployed.
One other consideration in the mix is that some people might be worried about the finances of Social Security. I hear from a lot of retired or pre-retiree investors who say that they really want to take the money and run because they're concerned about what might happen to the program down the line. How do you address their concerns?
Well, Social Security is facing a long-term financial shortfall that was already known before the pandemic, meaning that the most recent projection that was done by the trustees before the pandemic projects that the Social Security Trust Fund will be exhausted in the year 2035. And at that point, there'd be sufficient monies coming in from current payroll tax revenue to meet about 80% of the promised benefits. So it implies a 20% or 20% plus cut in benefits. Very few people expect that to happen. There are a number of ways to fix that problem. And my expectation is Congress is going to fix it before 2035 arrives. Now, the pandemic may well accelerate that date a bit from 2035. And the big reason for that would be the decline in payroll tax collections because of the down economy. That would be the most important reason. And so the Social Security actuaries have said that the depletion date might move up a year or two, 2034, 2033. That said, you want to asterisk that and say, if the downturn is longer and deeper than some might think, it could move up even a little further. But we're not talking about a program that's going to implode tomorrow by any stretch. And so I don't think that there's a good reason for people to think about uncertainty of Social Security as a reason to file early.
So nonetheless, though, it seems like there are a lot of different factors, very personal factors to get your arms around in this decision. Maybe a good place to get the advice of a financial advisor. How about tools that you recommend in the realm of trying to figure out what are the trade-offs involved with various Social Security filing dates?
Sure. Well, one thing that I would recommend, which is not a tool so much, but a really, I think, very good, cogent, and succinct book about Social Security is called Social Security, The Inside Story by Andy Landis, who's a gentleman who used to be a Social Security employee. And it's just a very straightforward, easy to understand guide to the ins and outs of the Social Security rules. That's one tip I would offer. A second, and again, I'm going to get to tools in a second, but a second thing I would advise people to do is get a hold of your Social Security statement. Social Security used to mail out an annual statement, which is a very handy thing to have. It gives you a projection of what your benefit will be at different ages, shows you what the earnings history is that your benefit's being calculated from, so you can check that for accuracy. Used to come in the mail, but you can always get it online. You set up an account at the Social Security website, which is something people ought to do anyway. And then you can, at any time you want, you can download a PDF of your statement. And so for any exercise around claiming and decisions, a good starting point is to have that statement in front of you, because a lot of the tools that you use will ask you to plug in a few key numbers from that statement. So go get that. There are a couple of tools out there that I think are pretty good, that they're very good actually, that charge a small fee. The best tools out there are fee-based. They're not super expensive, but I always like to point out, with a decision this important, a little bit of money invested up front could pay very, very large dividends in terms of an optimized benefit. One outfit I like a lot for this is Social Security Solutions. Another is called Maximize My Social Security, which comes from ES Planner. That's a broader planning device that was founded by the economist Larry Kotlikoff. There are a couple of free tools out there that are pretty good. They generally lack some of the sophisticated features for decision making that you find in the fee-based tools. They typically, for example, don't allow you to do spousal and survivor planning, but nonetheless, they're not bad. The Social Security Administration itself has one called the Retirement Estimator. AARP also has one called the Social Security Benefits Estimator that's pretty good.
Okay, Mark, timely discussion. Thank you so much for being here to share your perspective.
My pleasure, Christine.
Thanks for watching. I'm Christine Benz for Morningstar.com.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit Morningstar.com/Alexa. Now, Susan Jabinski and Christine Benz from Morningstar Inc. explore strategies to upgrade your portfolio during a recession.
Hi, I'm Susan Jabinski with Morningstar.com. The U.S. economy has officially entered a recession. Many investors may be wondering what that means for their portfolios and if and how they should respond. Joining me today to discuss that topic is Christine Benz. Christine is Morningstar's Director of Personal Finance. Christine, thanks for being here today.
Susan, it's always great to be here. Thank you.
Now, before we get into any specifics about how you might upgrade your portfolio in the face of a recession, let's take a step back and talk a little bit about, what are your thoughts regarding whether people should be thinking about their portfolios and making changes to them in terms of where the economy is?
Well, I think you want to be careful about being too reactive. Certainly, there's a lot of scary news about the economy, lots to still be worried about despite the market's recent rally. But I think you do want to be careful about basing your portfolio adjustments too much on what we see going on with the macro economy, because the fact is prices in certainly a lot of categories that are deemed more economically sensitive are really factoring in pretty bad news. So bank stocks are factoring in the notion that interest rates are going to stay down for a really long time. That's typically not good for banks. Energy stocks have also really struggled with with the expectation that demand for various energy products will stay low because of low economic growth. So a lot of bad news is already priced into the market. I think you do want to be careful about being too reactive, and this applies to every market environment, good and bad.
Now, that being said, there are some things that you think investors could be doing or thinking about at the fringes of their portfolios today. One of those things being paying attention to the costs of their portfolios.
Right. This is an evergreen sort of piece of advice that we often give investors. But really, I think the time could not be better to take a look at your total portfolio, look at all of the expense ratios that you're paying on any funds or ETFs or anything else in your portfolio, and see if you can't bring those costs down. And the big benefit, of course, is that you have the potential to improve your take-home return. And I think that's really valuable given that when you look at return forecasts from the major shops, not just for the near term, but for the longer term, what you see are pretty muted return expectations, certainly for fixed income investments, as well as for U.S. large cap equities. So whatever you can do to trim your portfolio's cost load, I think is time well spent. So you can find an expense ratio for funds either on your fund company's website or certainly on Morningstar.com. Morningstar.com also has a helpful one-word explanation of whether a fund's expense ratio is low or above average or whatever it might be. And so you can quickly get your arms around where your portfolio's problem spots are. So I would say that's a great starting point for investors who are just trying to improve their portfolio's long-term return potential.
Let's talk a little bit specifically about the bond sleeve of an investor's portfolio. Is now a good time to be considering improving the credit quality there?
Well, again, I think you want to be careful about being too reactive because we have seen quite a flight to quality through this period of economic uncertainty. But I do think that investors who are getting close to retirement or in retirement should just really take a closer look at their fixed income exposure to make sure that it delivers appropriate ballast in an equity market shock. So look back to that period in the first quarter, look at how your holdings performed during that period. Generally speaking, high quality bonds did an okay job of holding their value. Nothing held up quite as well as treasuries during that period. So I think it's reasonable, especially if you are expecting to begin to spend from your portfolio, certainly within the next 5 years or so, to make sure that you have de-risked your fixed income exposure to the extent that you have higher risk, higher returning, higher yielding fixed income types. I think you'd want to make sure that you have a longer time horizon for them and that you have also balanced them with higher quality holdings.
And let's turn to equities. So does it make sense with our equity portfolios to think a little bit more defensively or think a little bit more about quality, or are we a little bit late for that?
Yeah, I think here you do want to be careful about being too reactive. Investors are often a day late and a dollar short when it comes to these moves. But I would say again, for people who are getting close to retirement, especially for those who have been unnerved by some of the market volatility that we've experienced, you could potentially look at giving your equity portfolio a little bit of a higher quality cast and plan to keep it there throughout your retirement years. So one strategy that I know our team really likes in general is kind of a dividend growth strategy. So as opposed to a strategy that anchors on high yielding equities, I think the idea here is that you're looking for companies that have had a history of growing their dividends over time. These tend to be highly profitable companies. They're often what we call wide moat stocks at Morningstar. And so what we see is that they tend to hold up a little better during equity market shocks. That's what you may be looking for in retirement. So Vanguard Dividend Appreciation is one we like. Vanguard Dividend Growth is another that we like. T. Rowe Price also fields a terrific dividend growth fund with this same type of strategy. So the basic idea is that you will have a higher quality cast to your equity portfolio. I would also caution, though, you want to make room for diversified exposure in your portfolio. So we've seen a long running period of underperformance in value stocks. You want to make sure you have exposure there. You also want to make sure that you're not completely missing out on some of the high-flying tech names that at various points in time pace the market, such as in 2020. So diversified exposure is what you're going for, but for people who are getting close to drawdown and feeling more uncomfortable with equity market volatility, I think a dividend growth strategy can be a nice addition to that portfolio.
That's great. So never forget diversification.
Right.
Christine, thank you so much for your time today.
Thank you so much, Susan.
I'm Susan Chabinsky with Morningstar.com. Thanks for tuning in.
Watch all the Morningstar content you love from your living room. Download the Morningstar Roku channel and get up-to-date independent insights on today's markets. Be comfortable. Be informed.
Next, we share 2 stocks our analysts have their eyes on. Early in July, Morningstar's equity analysts updated their list of attractive ideas. Here's a look at 2 of the new additions. Newcomer Carrier, a leading supplier of climate control and fire and security solutions, was spun off from United Technologies in April 2020. We initiated coverage of Carrier in late June with a narrow moat rating, stable moat trend, and a $32 per share fair value estimate. In our view, Carrier has the strongest overall product portfolio of the major HVAC players, which also includes Johnson Controls, Trane Technologies, and Lennox. Carrier has historically had the strongest profit margins in its peer group, and its growth prospects have greatly improved now that it's a standalone company with complete control over its capital allocation decisions. We see no reason that Carrier should trade at a discount to Trane, which has a similar yet less comprehensive product portfolio and lower profit margins. While Carrier's stock price has appreciated significantly since it spun off from United Technologies, we think the market hasn't fully appreciated the company's growth and free cash flow generation potential. We still see plenty of upside. New addition Merck's combination of a wide lineup of high-margin drugs and vaccines, along with a pipeline of new drugs, should ensure strong returns on invested capital over the long term. We assign Merck a wide moat rating, stable moat trend, and a $100 fair value estimate. Merck is well positioned to gain further entrenchment in immuno-oncology with Keytruda, which holds a strong first-mover advantage in the large, first-line non-small cell lung cancer market with excellent data. Also, we expect Keytruda to gain approvals in early treatment settings, which should open up underappreciated sales potential. Additionally, Merck's vaccines look ready to drive further gains, led by human papillomavirus vaccine Gardasil, which continues to generate excellent clinical data. While the firm's late-stage pipeline lacks several new blockbusters, we expect early-stage assets focused on cancer to move through trials rapidly. Even though Merck faces some patent losses over the next 5 years, including diabetes drug Januvia, we expect new drug launches and gains from currently marketed products, like Keytruda and Gardasil, to more than offset generic competition. And lastly, RJ Hottovy from Morningstar Research Services comments on Amazon's big presence in the market. While you're watching this video, you very well could have a package from Amazon waiting on your doorstep. You might even be able to check using your Ring home security system, which is an Amazon company. Maybe you're even watching this video while in line at another Amazon company, Whole Foods. Amazon is a massive company with many services, but does size alone make for a good investment? Quick history. Founded by entrepreneur Jeff Bezos in 1994, in what is a humble, albeit familiar story for startups, Amazon started out of a garage. The original name for Amazon was Cadabra, but Bezos changed it to Amazon after somebody misheard it as cadaver, which, good call, Amazon is much more clear. Anyway, after noticing that web traffic was growing at 2,300% a year, Bezos wanted to build a virtual bookstore with millions of books, something that couldn't exist in the physical world. It worked. From there, Amazon began to expand to CDs, movies, clothing, as well as companies and services, including IMDb, Prime membership, Audible, Zappos, Twitch, Ring, Whole Foods, Amazon Web Services, Amazon Studios, and more. Obviously, Amazon is big, but sheer size isn't a strength unto itself. So how exactly is having everything from a video game streaming service to selling shoes a strength? For that answer, let's throw it over to Morningstar research analyst RJ Hottovy.
Looking back the last several years at Amazon, a lot of the acquisitions the company's made can seem scattershot. Things like Whole Foods and Twitch On the surface, it doesn't seem like these businesses fit together, but in reality, I think what Amazon is trying to build is a more diversified service offering. In reality, most e-commerce companies don't make money on the products they sell. Instead, they make it up on the services and subscription offerings. The different things that they currently offer, including Amazon Video, Amazon Music, Audible, and Twitch streaming. These are a lot of ways that Amazon can make up a significant amount of profit through these businesses, and more importantly, lock you into their services. Players like Walmart and Target and Netflix each have certain aspects of these services, but at the end of the day, they don't have the complete package. I think ultimately that makes a much stickier customer experience for Amazon users.
Well, that's a quick look at Amazon, but if you want to know more about this self-proclaimed everything store and whether it is overvalued or undervalued right now, check out our full analysis of Amazon on Morningstar.com or on 1,500 other companies. We do cover a lot. That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar, Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.